What's the right way to take money out of a pension when I get older? And what happens when I die? Am I willing to give up a future pension because I have rent to pay? I want to stress that people are intimidated by financial planners because they feel like they are going to be told this is what you should be doing, but you're not doing it. The higher your disposable income is and the lower your commitments are personally, then the more freedom you have to do what you want. I'm not going to be here tomorrow, so you can't take it with you. Yes, that's fair enough. But in reality, what happens if you get to that point and you're still here? I get people to the point where they really understand the damage that they're doing to themselves by not doing stuff with their money. Then they realise it's not particularly ideal that I don't want to do it, but I understand that it's the right thing to do. You can learn something now in the next hour or the next half an hour that your accountant's never told you. Some of the richest people that you could ever meet, they don't look like they are. If you're willing to accept the fact that inflation is doing damage to it, that's fine. But in reality, you should be doing things like
Series 8 of the Dig podcast. I can't believe it, guys. We are over 250,000 downloads. The growth of the podcast has been amazing. But I just have one thing I'm asking of you guys today. If you love listening to the Dig podcast and you love all the new guests each week, then I'm asking if you could hit subscribe or follow. So if you listen on Apple or Spotify, if you could hit follow, and if you watch on YouTube, hit that subscribe button. It means the podcast reaches more people. When I reach out, people actually have heard of the Dig podcast, they know about it, and they're more willing to be a guest. And then I'm able to bring even more actionable advice to you guys. So it's really, really it really helps the podcast grow. So I'm asking for your help on that point today, and I just can't wait to dive into this series, and I can't wait for you to hear from our next guest.
Welcome to this week's episode of the Dig podcast. Spend less, cut out the crap, work on earning more, and make better decisions. Is that just not what it all boils down to? So I am speaking today to Orann Coyle, who he first caught my eye on social media, and I have been absolutely hooked ever since. Orann is a financial advisor, and he provides wealth management and financial planning advisory services UK-wide for highly complex, this is what's written on his LinkedIn now and his socials and stuff, high net worth clients, including intricate investment, pension, trusts, and estate planning. But he also helps people like us with his knowledge and his guidance on his advice on social media. And he's helping people all over the world. I know it says UK wide there, but my God, when you go on social media, like, you can reach anywhere, and he absolutely is. And he's agreed to be on the Dig podcast. So I'm going to put him in the hot seat because money is not my strengths. I don't understand a lot of it. I don't know how to be better with it. And he's definitely going to help us. So I'm going to ask him all the questions that I know you guys are down to know as well. And I suppose I just want to say that before we start, what Orann and I talk about today and what he is telling us today is not advice, it's guidance. So if people want advice for their own situations, then they need to reach out to Orann specifically, directly, or whatever. But this is just guidance, and it's absolutely unreal guidance, and definitely is a great place to start. So thank you for being on the Dig podcast, Orann.
Thanks very much for having me. I hope it's useful. And as we say, although it's guidance, it'll be very useful. And of course, any other questions that you have or anybody else has, they're very welcome to ask them.
And we will be linking all your socials on the show notes, and people will be able to go on and see exactly why I felt like I really wanted you to have you as a guest on the Dig podcast. So money, Orann, does money make the world go round? Is that a right saying? Am I right in thinking this? Or what's the crack with the money mindset that we all be in?
Well, the unfortunate answer to that is yes, money does make the world go around. And I suppose that money in reality is flexibility, Charlie. We both know that. Flexibility of choice, and to be able to do the things you want to do when you want to do them. So my job as a financial planner in terms of mindset is to help people who generally might not have ever had a good perspective of money get in and have a better perspective of money, or people who already have a good attitude or beliefs about money, put a plan in place that helps them to get from A to B. So a lot of people, which is weird to say, is they will be earning well, they have a good life, and they're in good financial standing, but they're not really fully aware of where they are right now and their own financial circumstances. So when it comes to actually trying to improve your finances, it's very difficult to actually find a way to go forward because we don't know where we are right now. And so that's one of the big basics is on paper or in your head or in a simple way, do you actually know where you stand financially so that you can make plans to improve? The mindset thing, I suppose everybody has a different perspective. As I've said, myself and you will have a different perspective on money and how we portray financial success. The average person would say financial success is having a home, having no mortgage, having no debt, having a reasonable amount of earnings, having a reasonable amount of savings and comfort, which is really the epitome of the middle class. Some people will say, well, to me, that's not success. Success is being worth £1 million, being worth £2 million, or whatever it may be, or earning 200 grand a year. And there's no right answer, Charlie. Over the last few years, I have experienced people from the lower end all the way up to the higher end, and I've learned a lot from how they actually perceive money itself and how they use money. And the funny thing is that whenever people end up with more money, it's not that anything particularly changes in their lives. Obviously, their quality of life gets better, but when it all boils down to it, they just know that they're comfortable and they have freedom to do things. They have freedom to help their family and they have freedom to do this and that. And that takes away a lot of the stress and pressures of life. And that's what it boils down to for me, is living life by design, having the freedom and flexibility to do what you want when you want to do it. And, financial stress and financial problems are a big part of the stresses of life in general. So if we can just make them a wee bit better, not completely move past them, because not everybody's going to be a millionaire, but if we can make them a bit better, it just makes life seem a bit more, sunny, if you want to call it that, right? That's the way I see it anyway, and that's what I've learned over the last few years from clients. So,
and when I listen to you, and when people who are listening to this on the podcast, I would always have thought if you needed a financial planner or the services of one, it meant you had money. Like I'm like, is that right? Or should you be doing this even? I'm not saying we don't have money, but I mean, when do you need a financial planner? Should everyone be considering this type of planning in their life?
That's a really good question, and it's a hot topic for me at the minute because generally, the stereotype is you have to have money to get financial planning, right? And wealth management is what it says in the tin. You're managing people's wealth. But the extent of the wealth that people need is generally not as much as people would perceive. Obviously, there's people out there in my profession that only deal with the creme de la creme, and if you don't have £1 million, they're not going to talk to you, which is fair enough. That's their niche, and that's where they position themselves. And there is instances of that here in North of Ireland and over in the mainland, so that's fine. Overall, though, the answer to that is no. You don't need to be a wealthy person to get a financial advisor, and the reason is, if you're trying to get wealthy, you're not going to be able to do it on your own. So you need a financial planner, right? So you need good information, and you need a plan, and you need somebody who you can trust and somebody who can support you and you trying to achieve what you're trying to achieve. And that might start with somebody who is earning good amounts of money, but their background, their familial background, means that they've never really been around money in their lives. And so now they need somebody that can help them and will be patient with them and help them understand how they can get wealthy, why they should want to get wealthy, or why they should want to improve their circumstances, right? My role and where I fit into this is, there's a big gap in terms of, online money conversations in the UK. There's not a lot of people talking about it. And my where I position myself is, I've sort of decided that I'm just going to give as much free information and value as I can in the UK. And that's obviously why what I'm doing online is starting to get traction, because a lot of people would be intimidated by a financial planner. And they cut the long story short. I give people advice that earn 30 grand a year, and I give people advice that earn £500,000 a year. If you want to have a conversation, I'm not going to be the person that says, no, I'm not willing to talk to you because you don't have enough money or you don't earn enough money. To me, that's just, that's not fair. You're sort of shutting the door on somebody, and you're really putting something in their mind that says they will never speak to a financial planner again. So I can't go to bed at night with that on my conscience. So I'm willing to have a conversation, as casually as I can, as you can see here. And that's how I like to do things, so that people can have the opportunity to ask the questions that they want to ask. Sometimes that leads to a lot of endless conversations where people just want, support in general. And yes, I have to draw a line under how much free time I give away in general. But ultimately, you end up meeting a lot of people, and I'm very grateful for some of the people I've met. And you would be surprised at where it leads you. You could speak to one person, and that person could take you to speak to somebody else, and you never would have thought. And so it's taught me a lot about assumptions, financial assumptions. Some of the richest people that you could ever meet, they don't look like they are, and that's something that they're walking.
Sorry, what did you say? They don't
look like they're rich. And a lot of people here, especially in Northern Ireland, stereotypically people are very cagey about their money, and they don't like letting people know that they have money or they don't. And it's always exciting to see somebody new come in the door, and you think you could make a presupposition or an assumption about their finances, but you could be completely wrong. And so that's one thing that I've learned. But to answer your question, everybody should have a financial advisor of some sort. I'm trying my best to give free information. That means that they don't necessarily need to engage one without really needing to engage one, because all the free information they need is on my social media. But generally, yes, I would like to see everybody taking advice of some sort, especially when it doesn't cost money. And that's the other thing. A lot of people think that they have to pay a financial advisor to go and see them. I don't charge for my time, so I could have a 3-hour meeting that doesn't cost any money.
What do you mean?
We don't charge for it. So I represent the bigger network here in the UK, a FTSE 100 company, and we're the biggest wealth managers in the UK. I think we're managing 168 billion as of January, right? So we're the biggest in the UK in terms of what we manage. But our business model means we do not charge for our consultations or our time, and we actually give our advice first before we charge our client any money. So even if it's 100 grand investment, for example, we do all the work and we present the advice to the prospective client, and then it's up to them to decide after a conversation, do they want to accept a recommendation or not, and then that's when charges come in. Some of our products don't have any charges at all, effectively, which I won't go into too much detail here. That's more of an individual thing. But, I have between 500 and 1,000 meetings every year with new people, and follow-up meetings, and I don't charge £100 an hour or £200 an hour for that. And so that's a follow-on from free information I give out online. They essentially free appointments, even though we don't call it that. They're no obligation appointments, but there's no money exchanges hands, so I can't do any better. Free information. You can have a meeting face-to-face, have a conversation, and then see what happens after it.
Okay.
Strange, isn't it?
Very kind. Wow, unreal. Amazing. And obviously that's all part of, as you said, your business model and stuff, and that's what
Right.
we're guys. But you are imparting all this information on social and teaching people, and I have learned so much from reading your socials. Now I find it hard, not gonna lie, and you're very straight talking and very easy language you use, but it's just not money and finance and all is just not something that I know about. So I'm going to talk to you today about, first of all, I want to talk about tax. So
The big one.
I know everybody's like toes are curling now and they're all like, yeah. So I am limited company. I have 2 limited companies. I was self-employed for 12 years in a partnership. Now,
Okay.
this isn't about me, but I'm just trying to give you an idea why I don't flip it on.
Yeah, that's right.
So tax is what is tax?
Well, tax is basically the slice of the pie that you pay to the man upstairs after you make your money, which, taxes in different jurisdictions around the world is always going to be a hot topic and a big talking point. But, we're in the UK, we pay our taxes and we pay the rates of tax we pay. So to keep it simple, we have a tiered tax system and we pay 0% tax, income tax. So there's different types of tax, by the way. So
Of course there is.
And so you have income tax, dividend tax, capital gains tax, stamp duty, land tax, and all these types of things. But income tax is the most important one for most people in the UK, especially if they're employed, self-employed, or running a business. So you only pay, don't pay any tax. You don't pay any tax on money you earn up to £12,570 a year. Most people know that. And from £12,570 a year to £50,270 a year, you pay 20% tax. And from £50,270 a year up to £125,000 as of April last year, you pay 40% tax. Anything above that, you pay 45% tax, right?
And this is turnover, not profit.
No. So this is personal. This is for your personal income, right?
Personal.
So there's a separation between personal earnings as an employee or a self-employed person, right?
Mm-hmm.
Versus being a company. So, and I'll come to that in a wee second. So you have your personal earnings, right? If you're an employee, if you earn 50 grand a year, you pay 20% tax. If you earn 100 grand a year, you're paying some 20% tax and you're paying some 40% tax. If you earn 150 grand a year in your job, you're paying some 45% tax too. So it's layered up depending on what you earn. And that's the same when you're self-employed, Caroline. So your self-employed profits is what you earned as a sole trader or a partnership. So a partnership is two self-employed people together, minus all your expenses, your attributable expenses that your accountant can weave in. And then you pay your tax based on your profits. So if your profit's 40,000 for the year, you pay 0% tax on the first 12 and a half, roughly, and then 20% on the rest, and so on and so forth, based on those tax rates of 20, 40, 45%. So the reason that a lot of people get caught in the trap when it comes to being self-employed, or i.e. a sole trader, and being a limited company is, when do they make the change between being self-employed and being a director of a limited company? Generally, there's a rule of thumb which will be one of two things, which is when your revenue hits the VAT threshold, when you become a limited company, right? And the second is if whatever you're doing for a profession or what your business does requires clear and clear-cut limited liability, is when you move it into a limited company, because that's what a limited company is. It's a separate entity to you. And obviously, if you own two businesses, you, Caroline, are the puppet master, and then you're pulling the strings to do with your two businesses. But that doesn't mean that you personally are getting taxed on all the money that those businesses make. It's only the money you draw from them that you get taxed on. So there's a certain level of...
how bad, just to jump in, how bad is it that I don't even really... This is... I probably shouldn't even be saying this on a flipping podcast, but I actually didn't even realise that... You meet people that are like me that actually don't realise the concept of that and what that means. You just go along with all these things and you're like, oh, what does it mean for me?
Well, do you know what? I think in a lot of cases, we all put a lot of trust in accountants, to be honest with you, for accountants to keep us right, keep us within the white lines and tell us what the most important things are for us. But again, without throwing any shade, that's a dangerous game too, because that means that, you're sort of attributing your life to your accountant, when you really should be educating yourself, especially in this day and age, so that you can challenge your accountant and ask your accountant questions, because I get challenged all the time and I have to be able to justify why I'm saying these things. And so your accountant should be no different. A solicitor is no different. And sometimes we take an accountant's word as Bible when that's not always the case. So that's not to offend anybody, but that's just for people to start asking questions of their accountants, because in the last year, especially whenever the economy forces people to think more about money and the purse strings tighten up a wee bit, the accountants start getting asked questions, and then the conversation is, I don't feel like my accountant is trying to save me tax, or I don't feel like my accountant is trying to suggest things that can save me tax, which ultimately isn't their job. It's not their job to say, start a pension, do this, do that, lease an electric vehicle or whatever. But a good accountant will signpost it for you and say, you really should be considering this now because you're at this level. Or you own a business now, instead of taking a 50 grand salary, you should be taking a salary and dividends instead. All these types of things. So it is a bit of a minefield, but the concept of tax for people themselves, most people are employees anyway, Caroline, so they are in the normal system of PAYE taxes. Most people don't get bonuses, so there's no really complicated matters when it comes to taxes. But self-employed people and business owners, limited company owners, need to pull the straps up and really get educated on how they can help themselves, because you can learn something now in the next hour or the next half an hour or whatever that your accountant's never told you. And then the question is, what happens next? You know?
And not to diss mine, because he has told me this, I'm sure, in the past, but what I find with education for me is I need to be educating myself all the time to keep it in here and make my process situations and understand what that means. So it's up to me, as you said, and up to everybody that's listening, to throw ourselves into this and educate ourselves as much as we can, ask questions, speak to people like you, speak to others in that field. So this is maybe going to inspire them today to take that action. It definitely has me. I think I need to be doing something every month to educate myself in all of this, because there's so much.
Potentially, yeah, but I suppose it's understanding. See, if you learn something and you understand it the first time properly, you'll never forget it again. And so I'm trying my best. I'm not the best at this. Obviously, I'm not perfect, and I'm finding my way with a lot of things too. I'm trying to explain things so that they stick. You know, when I throw it at the wall, it sticks. And there's no technical jargon involved, so that when you move on, you understand what it actually means. And that's all these meetings that I have where nothing actually ends up progressing with the client. At least they walk away with, you know, a better understanding of what they should be doing. And maybe they can come back in the future. Maybe they won't. But at least I've given them something, you know, and they've left with some value of some sort. Which, as we go through some of these next things now, hopefully it'll be a bit more enlightening, if you want to call it that.
Yeah, so let's move on to that. So we know now we have to pay our tax, no matter who we are, we have to pay our tax. It's just different people, it means different things. But how, the most important question could be of the whole podcast, how do we save from paying? Like, what's the right way to say that? How do we
that's fine. Reduce.
How do we reduce the amount of tax we have to pay? Because it's not easy when you work so hard and you're like, right, oh my God, I feel like I haven't made any money because I'm just like paying it all away. So that's exactly the way I feel sometimes. I'm like, oh, sure, I'll work my butt off there for a year and I really still have no money. So how do we figure this out and try to save here?
Right. So the biggest question, obviously, whenever somebody says, how do I avoid tax? It's number one is ascertaining what's saving tax and what's evading tax, because people will just say nothing, they evade taxes. And in reality, from my experience and what I've seen with other people in the past, it's all well and good saving £1,000 every other year for a couple of years. But when the big man comes knocking at the door and hits you for 3 or 4 times as much as you were supposed to pay in the first place, it never really falls in your favor. So the best thing is to do everything right by the book at the start, which ultimately can lead you on to having opportunities to do other things, which I'll come back to. And that's one thing that I'm trying to help people understand as well. But saving tax, right, that can be broken down into if you want to save tax personally, if you want to save tax as a business, if you want to save tax for your future, if you want to save tax for your children, if you want to save inheritance tax. So there are loads of different things. But the standard employee who is a PAYE employee who gets their taxes taken off them by their work, they pay national insurance and a student loan of some sort and an employee pension. Hopefully everybody that listens to this is still in their workplace pension if they have one. If not, you need to have a conversation with yourself and get back in it. Because opting out of a pension is the first mistake that people make in costing them.
We're going to talk about this. I need to talk to you about this. We will talk about this after, because EJAR did this and now we're backtracking because of
right. Okay, right.
Talk about that. Okay, keep going.
So essentially there's a couple of different ways where you as an employee can save tax, and the first and foremost one is through your pension. So your employer will take money out of your wages and pay it on their pension for you in one of two ways. You've got what's called the net pay method, where if you get paid £1,000 a month, hypothetically, and £100 a month comes out of your wages for your pension, that £100 goes into your pension, and then the government will top it up with basic tax relief, which is essentially 25% on top of whatever you put on it. So if £100 comes out of your wages and goes into your pension, the government gives you £25 for free, right, on top of that. But then your employer is also paying on top of that as well. And in the UK at the minute, the auto enrollment laws is 5% for an employee and 3% for an employer. So 8% in total of your annual salary, which, you know, if you're making 50 grand a year, that's 4 grand a year. Over 20 years, that's 80 grand. Over 20 years with growth, that could be nearly 200 grand. So it sounds stupid, whenever you opt out at the start, well, I'd rather have that 100 quid in my pocket. But in reality, you could be doing yourself out of hundreds of thousands of pounds over the rest of your life, right? Tax efficiently. But when that money comes out of your wages, that doesn't have to be the be all and end all of what you put under a pension. You can put more in if you want, and that comes directly out of your pay, and you don't pay taxes on that money that's coming out of your pay. So generally what will happen is people who are earning more than 50 grand a year, for example, are paying 40% tax on some of their earnings. With me?
Yes, I'm with you. Yeah,
So
so concentrating. I'm like, right, okay,
if they opted to put more money into a pension at work through net pay or through salary sacrifice, then they don't pay that 40% tax on that money because it's going into their pension and the employer's doing it for them. So that's the most efficient way for an employee to do that. Obviously, the caveats with pensions is you can't access the money until you're older.
This is the thing.
Right.
Stop right. I just want to talk about this. So me and John, right, we're very, like, I will openly say we're always thinking of the future, yes, but we're very much for here and now. And when we were going through, like, we're married 15 years and we're going through all these times of being employed, self-employed, all of that, we talked, and this might sound so foolish and might sound so uneducated, but me and him both were like, but you could be dead tomorrow. I want my money now. I don't want to put my money away. This is what we said. George said, why can we not just keep our money, and if we were dead, now our money, and I was like, no, now we have kids and we are starting to think differently, but when we were single, talk to me about that. Are we the only ones that have ever said that to you?
Definitely not. No. So, like, that's a mindset thing, right? And so, at the end of the day, here for a good time, not for a long time is generally a rule of thumb for a lot of people. And the average financial planner will try and convince you of the benefits of paying into a pension and the benefits of doing these things. But in reality, what you need to be thinking about is what you're missing out on, what you're losing. Because if we earn relatively substantial amounts of money, if you earn good money, and that's average wage in the UK is 35 grand or something, right? That's fine. But if you earn 50, 60, 70 grand a year on your job or as a self-employed person, then every time you opt out of a pension, you're handing away nearly 40% of your money to the man upstairs because you want that extra money in your pocket. And that extra £100 that you might get paid is really only £60. It's not 100. So if that money had went into a pension, the benefits are twofold, really. You're not paying tax on it, and it's actually working for you like an employee in the markets. They grow bigger for the future. And so you can focus the other money that you have on having a good time or doing other things. But in reality, you're probably losing out on more than you're gaining by not paying into a pension, for example. A lot of people are like that. And,
what about the person that's just making ends meet?
Okay, right. So this is another thing. Either way, right, there's two ways you can look at it. Someone might say, I want to opt out of my pension because I need the extra 60 quid of my wages, which is fair enough, right? And we've all been through periods like that and experienced times like that in our lives. Some people are there and some people aren't. The only flip side to that is if you are through that period the whole time when you're working in your career, whether or not you're making 18 grand a year or 25 grand a year or 45 grand a year, you have to draw a line somewhere, Caroline, and decide, is my whole life going to be like this, or am I going to struggle? But whenever I get to 65 years old, at least I can actually hang up my boots and say, fair enough, it was a hard slog, but I'm okay now, I can relax. And if you opt out of a pension where you're getting free money from the government and free money from who you work for, then, you've only yourself to blame, unfortunately, because making ends meet is one thing. And then there's making ends meet where you're saying, am I willing to give up a future pension because I have rent to pay? That's different. But if you're giving up that money and you're taking it into your pay slip, into your pocket, so that you can wax it on stuff that you don't need, this is going to be a bit controversial, I'm sorry, but then I can't help you. I need to help you understand why the pension's good for you in your future so that you can make your own decision, but I can't force you to do it. And yes, life is expensive at the minute. And when we are self-employed or we're just trying to start a business or whatever, and we're trying to make ends meet, then the pension may have to be on the sidelines for a period of time. But when you are in the position that you can afford to do it, you should be doing it.
Okay,
That's the bottom line.
yeah, this is okay. That helps me understand because I suppose, thank God, we've always been in a position where we could, but we wouldn't have had loads. Like, we don't have loads, but we would have been in a position where we could have saved that £100 for sure. But we opted out of it because, first of all, I have this mindset too: is it safe? Is it safe to give money to the bank? You hear all these things. Is it safe? Or
yeah, it is. So this is another huge question, right? And just before I move on to that, I want to stress that people are intimidated by financial planners because they feel like they are going to be told this is what you should be doing, but you're not doing it. And that sometimes can be the case. But in a general sense, you know, everybody has timing in their life, and everybody is on a different path. So there's sometimes when you have to swerve some of the things that are good for you in order to do other things, like set up a business, raise your children, or do whatever you need to do. But as long as you come back to the dumb thing at some point, you're okay. And it's my job to keep you as close as I can keep you to that path. But sometimes you may swerve off it because of other things, and that's okay. That is fine. Don't be scared to say that to somebody. You know, some people pay into a pension their whole lives because they have a secure job. They pay their £100 into their pension. They get a few quid from their employer and tax relief, and that's fine. In 25 years' time, they'll be grand. But when you're self-employed or you run the business, it's a lot different. You know that, and everybody else will know that too. So, coming on to your next question, are pensions safe? Massive question also, because there is a big there's a lot of cross wires between public sector pensions and private pensions, right? Public sector pensions being government-backed pensions to do with nurses, housing executive, water systems, schools, teachers, firemen, you know, civil service type pensions. And they are different to private pensions, right? So essentially, public sector pensions are like a group. They're like a huge pot of money that are some people are paying into, the people who are currently working, but the pot is also paying out to people who are not working, if that makes sense.
Yeah.
So it's sort of a never-ending cycle of money going in and money going out, right? And that money is generally sort of backed or invested in very low risk and safe government bonds or gilts that produce some returns, which is like interest. So it's like interest bearing that helps manage that money and pay out to people who have retired. So essentially, if I'm a nurse, I've paid into my pension sizably over a 40-year period so that I can get money back out when I retire, right? But whenever I'm getting paid out, my money that I was paying into the scheme could be paying out somebody that was retired 15 years before me. And it's the people after me that are paying into the pension scheme that's paying for my retirement. You know, that's the way I like to look at it, right? A private pension is completely different than that. And so the public sector pensions are based on the public sector, people paying money into them, what they're paying into them, if there's deficits or shortfalls, how the government bonds are performing, that the underlying pension is invested in. So whenever there was news a couple of years ago about the NHS pensions being under a bit of pressure, right? That's fine. That happens from time to time, and the government sorts it out or whatever. But a private pension is completely different. Your private pension is literally your wee pot of gold that you have. No one can touch it. Your employer can't touch it. The government can't really touch it. It's free from bankruptcy. It's free from inheritance tax. The only real risk that a pension faces is being invested in financial markets, the stock markets and the property markets and so on and so forth. And that's a systematic risk of being invested in markets. The value of your money will go up and down every day. But generally and statistically speaking, if it's invested properly, it will have a high probability of growing in the future. And the risk of loss will be minimal if it's done properly, right? The only time where I've ever seen somebody lose money in a pension is when they've received very bad financial advice, where they've been suggested that they invest their pension funds in foreign property and somewhere off the beaten track in that development where they're buying off-plan properties in some weird country, right? Not that the country's weird, but not the usual. That's generally where most people would go wrong, or they've made a bad investment decision to do with trying to invest in a business or something like that with a specific type of pension. But generally, you know, pensions are very safe, and they're basically savings accounts that have a bit of a kick so that you can grow your money for the future.
recently I've been doing some research on different like conditions, family, like things that are going on in different health conditions online. And, it's very hard sometimes to find the right information. And definitely my go-to now is Mars Pharmacy. I found Mars online during COVID actually, and started to follow the owner, Una, and all the unreal advice she was given for everyday issues that we all experience, educating us on things that are going on in everyday life, but we just don't know the facts and how to treat those things and how to, what we should be doing, and just unbelievable education really. And that was started my relationship with Mars way back a few years ago. And we're absolutely delighted that they're now the partner for the Dig podcast. And you're going to hear a little bit more about them today.
At Mars, we are proud to serve our communities, arming our customers with knowledge and information needed to take control of their health. Our expert teams are on hand to support and advise you in relation to all areas of your health and well-being, whether that be vitamins and supplements, hormonal health, gut health, or skin care and beauty. At the Mars Skin Lab, we offer a wide selection of tailored skincare treatments and products from cosmeceutical ranges, including Image Skincare, SkinCeuticals, and Murad. Call into any of our 10 stores in Dublin or visit us online at marspharmacy.ie, or you can contact us on social media for advice and support. Shop our wide range of wellness, beauty and skincare products online at mars.ie. All orders are packed with care in our busy Dublin warehouse, and don't forget we also ship to Northern Ireland, and you can enjoy 15% off all full priced items online with the code DIG15.
Thank you so much for that, Una. And now back to our guest on the Dig podcast.
So you can have a pension, you can pay in a pension and never, am I right in saying this is, and I shouldn't be saying anything because I'm making myself sound so stupid, but you can then invest that pension in something. Is that what you're saying?
That's exactly what a pension is.
But can you have your pension without taking a risk of investing in something like that? Is that
so? A standard personal pension, right, is a pot of money where you put your money on it, and the term pension, that word is basically a one-word describer for a set of rules. So a pension is an investment product. We put money into it. The government will give you money for free by putting money into it. They're bankruptcy free. They're protected from inheritance tax. So they're not actually inside your estate for inheritance tax purposes. And they can then be invested in global markets. And they make it very simple. Something like the S&P 500. Your money is in your pension, 10 grand. That 10 grand is invested in the financial markets. And then the financial markets grow and have a probability of growing over time. You can keep your money in cash within your pension if you want. So just straight up, it's not a bank account per se, but it's held in a very low risk type investment called money market funds. It's basically just like £1 is 1 unit of a money market fund. But the reality is that over the next 40 years, inflation's going to creep up, Charlie, and your 10 grand's not going to be worth 10 grand anymore. So what we need to be talking to clients about is, if you have 100 grand in a pension today, right, and that 100 grand could get you by for 10 years of your life, hypothetically 10 grand a year, right? In 30 years time, when the price of a loaf of bread is £6.85 and it's not £1.50 anymore or whatever it is, then that 100 grand's not going to get you by 10 years anymore. So your pension needs to be bigger than that. Your pension needs to be as many times bigger as the rate of inflation, basically. And so that money needs to be invested. It needs to be invested. And the government gives you a kick up the arse by giving you free money first. So they give you a quarter based on what you put into your pension.
Even in this private pension thing?
Yes, exactly, yeah.
All right, okay.
Right? So, and again, not to complicate things, but that's different with a public sector pension, right? And I'll come back to that. But a private sector pension, you put your money into it, the government will give you free money if you're a basic rate taxpayer. So if you earn less than 50 grand a year, they'll give you 25% on top of whatever you put in, up to the maximum you can pay into a pension, 60 grand a year, right? So that means that you would pay 48 and the government gives you 12, right? If you pay higher rate taxes, 40% taxes, whenever you're doing your self-assessment with your accountant, you can claim back more tax from the government against your tax bill, right? So at the end of the day, you have to take some risks, and pensions are the safest way of taking risk because the government essentially gives you a 25% buffer, Jeremy. They're saying, you put 10 grand into a pension, we're going to give you 2.5. So that's basically a wee bit of free money that you can allow the value to fluctuate over time so you can feel comfortable. And if it's done right, the value may dip below what you originally put on the pension in the first place. That's okay. That's part of the game. And my job is to help people understand that your money will not go up every year. That's a given. It's not going to go up every year. Get it on your head. Some years it's going to go down. Some years it's going to go up. Some years it's going to do nothing. But in general, statistically, it probably will do quite well over a 30 or 40 year period. And the longer it's invested in the markets, the more it can actually work for you. So you going to ask a question?
No,
right?
just take a breath.
I'm going out on one here, but you know, there's a big difference between starting to pay into a pension when you're 30 and starting to pay into a pension when you're 50, because when you're 50, your money has to work a lot harder to get to the same place as the money that you started putting in a pension when you were 30, because you have less time in the markets to get growth, and you also have to pay a lot more money into a pension to get to the same place. So my view is, and what I'm trying to do, coming back to the social media, is if I educate you about it now and you understand it and you understand the benefits and what you're missing out on by not doing it, if you start it when you're younger, you don't have to commit anywhere near as much. So you can slice up a bit of your income or whatever, put that into a pension or investments or whatever, and then blow the rest of your money if you want, as long as you've got your future tidied up. That's fine. You know, and that's the way I look at it. It doesn't have to be a be all or end all. It's do something. If anything, do something, and that's going to put you in a better place. And if you want to blow the rest of your money, go ahead. Right?
Yeah. So the two things are, it's saving you tax, and it's the best way to make money for the future.
Essentially, because and I'll come to the alternatives in a second, but the next question will always be, well, what happens if I die? What happens if I never see 70 and I don't get my pension? The reality is, yes, that's a risk that you take. If you look on the ONS, the Office of National Statistics, the average person here has a life expectancy of between 85 and 88.
Oh, amazing. I did not know this. I'm so excited.
And a 20% chance of reaching 92 or 93, right?
Wow.
So if you have money and it runs out when you're 72, what do you do? What do you do? You're snookered. You're living off pension credits and the state pension, which is not enough. It's just not enough. So if you have a private pension and you pass away, generally before the age of 75, your pension will be paid out tax-free to whoever you nominate. So even if you don't get the benefits of that pension, somebody else can. And yes, you know, coming back to your mindset a few years ago, which was, what, I'm not going to be here tomorrow, so you can't take it with you. Yes, that's fair enough. But in reality, what happens if you get to that point and you're still here? It's sort of a dangerous knife edge to be dancing on, you know. And I've seen it, Caroline. I've sseen people that are in their mid-70s and they've got nobody around them to support them, and they're getting very little money, and it's it scares me. It does scare me, and I'm trying to take that as a way of trying to not be aggressive in the way that I sort of advise people, but be very serious about, you know, it's all fun and games that we're having a conversation here, but there's a chance that you could get to a point where you're barely able to heat your house, and that's what everybody's talking about in the UK at the moment, because the cost of things have went up. So it's
I think we need like hours and hours and hours to trash this out, but I want to talk about, I want to come back to more ways we can save tax. So that's definitely one of them, pension.
Right.
But
okay.
lots of family members, lots of people who I know, and me, like I would say openly, I do not I'm 41 and I don't have a pension yet. Now, I was an occupational therapist and I had a pension for a couple of years, stopped it, went self-employed. To be honest, I was not in a good money mindset whenever I had my shop, and didn't think that I could afford to give money out to a pension. And I was uneducated too, but I'm now realising, and I want to get this in place now. But people say, I don't want to leave my good job because I'm going to lose my pension. And that can be a big reason why people don't move from being employed to self-employed and follow their dreams. That doesn't have to be the case, doesn't it? Not like you can literally tell us, like they can move it over, right? Or something, or what?
Well, it depends on what type of pension you see. So, and we'll we'll cut on this and we'll move on to our next stuff because I don't want to dwell on it too much. But if you're in a public sector, like an occupational therapist, and you have a null gosh scheme or some sort of NHS scheme, or the most recent one is called the CARE scheme, CARE, the CARE scheme, right? That's a defined benefit pension scheme that has a lot of benefits and guarantees attached to it, and they're very good pensions. The only bad downside is you have to stay in them until you're 67, which is the problem, right? Whereas a private pension can be accessed from 55 or 57. Now in the next few years, it's going up to 57. So if you were an OT for a period of your career, you will have accrued benefits and a defined benefit, great pension scheme. Leave them where they are. And if you're self-employed, you can start a private pension and have two. Or if you are already in the public sector and you're also self-employed, you can also have two. Like dentists would be a very good example. They do a lot of NHS work, but they do cosmetic work as well. So they have two, right? But also, if you were on a job that was just a normal employee job and you had a private pension or a workplace pension with Legal and General or Aviva or Royal London or Prudential or whatever, and you leave that job, that pension can be moved somewhere else, or you can move that pension to a private one and start paying on it yourself. There's loads of things you can do. There's loads of things. So pensions from previous jobs are not dead. They're still there. You can do things with them, blah, blah, blah. But obviously you need to have a conversation with somebody to see the extent of that, right?
Absolutely. So I'd hear that a lot from people who don't want to leave their good job and inverted commas, their good pension, but that shouldn't be a reason to hold you back. So I know we don't want to talk about it too much because we want to talk about another topic here, but what else? I do want another thing that we could do.
Right. So
I want
the next thing,
20 things we could do, but give us something else.
So the reason I started with the pension stuff was because that's all the pre-tax paying things that you can do. So your pension comes out of your wages before you pay tax. Your pension gets you free money, blah, blah, blah. But after you've actually paid your tax and you've received your wages in your bank account, for example, the next thing you need to be thinking about then is high yield savings, which aren't exactly tax efficient, but I'll explain that, and ISAs, right? So everybody in the UK has what's called the personal savings allowance, which is the amount of money they can earn and just on their money, on their bank account savings before they pay tax, right? For a basic taxpayer, that's £1,000 a year. So you can earn £1,000 and just before you pay any tax. And if you're earning more than £1,000 a year in interest, you should really be declaring it and paying tax on it, right? Higher rate taxpayer is £500 and additional rate taxpayer is £0. So funnily enough, the more money you earn, the less availability of these things happens. But after that, then you have ISAs, and ISAs are essentially tax-free savings products that you can put money into. They can be invested in the markets with a stocks and shares ISA, for example, and so they can actually grow over time as well. But unlike a pension, they can be accessed before you're retired, so you can access them throughout your whole life. So you have a few different types of ISAs, right? You have a cash ISA, which is basically tax-free bank account savings, SIF, and you accrue interest at the moment 4 or 5% with your bank, right? The next one is stocks and shares ISA, which is an investment. So your savings are invested into the markets like a pension, so that they have a chance to grow over time. So your 20 grand could turn into 40 grand over a 15-year period, but you don't pay any taxes on any of the money that you've made, tax-free, exempt, right? No income tax, no capital gains tax, and you can access that money as and when you please directly at any stage in your life before retirement. So it's not locked away until you're 55 or 65 or 67. You can take money out of it tomorrow, next week, next year, whatever. You have the lifetime ISA, which is a big topic in the UK at the minute, which is generally for buying homes, which is where you put 4 grand in and the government gives you £1,000 for free. And albeit that's not a tax saving product, it's a tax beneficial product, right? And so those are the main ones that I want to stick with for now. But when it comes to saving tax, I want to talk about stocks and shares ISAs the most, right? Because essentially we're all looking for ways to make our money grow and make our money work harder for us. And unfortunately with inflation, that's not going to happen when your money's in the bank, Charlie. It's just not, you know. A 50 grand house 10 years ago was now 90 grand. So if you had 50 grand in the bank, you can't buy that 90 grand house anymore. You need another 40. So the only way that you can offset that is by making your money work harder and that is through things like stocks and shares ISAs, where your money is invested in the open markets. Again, relatively safe if it's done well, but it needs time. It needs 5 to 10 years to really work. But all the gains or all the profits that you make are non-taxable. And so whenever you look at tax structures or saving tax, my job is to help people split how they manage their money between things like pensions for the future and things like ISAs for the short term. Does that make sense?
Yes. And I suppose that's a whole other, that's a whole other conversation and that works and what way, how you should navigate that.
Yeah.
Good to know that those two options, I suppose, are there as well. And pension, where it's away till you're a certain age, but ISAs where you can actually access it if you need it. Right. Okay. I need to get my flipping husband to listen to this flipping podcast, because it's very traditional mindset of work hard, get your money, keep it safe, it's yours, don't let it be a habit and all. But I'm like, but Jared, now you're self-employed, and me too. Look, we're just trying to learn, and so's every podcast.
Can I say one thing too, though, Caroline, is there's a lot of self-employed people out there that, although there's tax benefits that come along with the pension and the fact that they're locked away until you're older, some self-employed people tend to opt for stocks and shares ISAs because there's security and the fact that they know, yes, I'm putting X amount of money in here, but if I'm stuck, I can take money out of it. However, the downside of that is if you're wishy-washy about taking money out of it and then you leave yourself skint and dry by the time you're 67, your hard work's been for nothing. So the way that I look at it is, how can we slice off a bit of what you earn and put that to work for the future and not really affect your life too much? And then everything's happy, fine and dandy. And that's a very weird concept, because people would expect a financial planner to squeeze every penny out of your pocket as they can. That's not the case. It didn't have to be that way. But tax-wise, people are always looking for ways to save tax, right? Standard employees that have a job and are employed, the only real options they have is pensions and ISAs. That's it. That is the long and short of it. Because they don't have the ability to write off anything, expense anything, pay themselves in a certain way from a company, and I'll come to that in a second. So employees are stuck with traditional: pay money into a pension, save money in the bank, invest money in stocks and shares, and hopefully over time you accumulate, some substantial money in those things. And like you're saying, especially here in NI, you've got traditional, stereotypical bloody grafters, but they're feared to do anything with their money because they mightn't necessarily trust the system, right? Let's just say it as it is, which is fine, or go down the property route, fair enough. But I am not a person that would say put all your eggs in one basket either, and I like to see people spread across a few different things so that you can keep a large chunk of money in the bank if you want. If you're willing to accept the fact that inflation is doing damage to it, that's fine. But in reality, you should be doing things like ISAs and pensions to get that money to work and offset the damage that it's the inflation is doing to the money you have in the bank. You know what I mean? So I think whenever I get people to the point where they really understand the damage that they're doing to themselves by not doing stuff with their money, then they realize it's not particularly ideal that I don't want to do it, but I understand that it's the right thing to do. And it's so weird because when people come to certain stages financially, they mightn't like a particular thing, but they're in the financial position where they have no choice because it's going to cost them more money than it's going to save them by not doing these things. It's really strange. So everybody at the lower end is looking for ways to save tax, but whenever you get to the higher end, they're like, do I really have to do this? Yes, it's only saved you 200 grand. Right, okay then. That's the way it ends up, which is mad really when you think about it.
The whole thing is just another, it's like a challenge to navigate, and it's hard because I don't feel smart when it comes to stuff like this, and I'm relying on people to tell me what to do. So you said that you were going to talk there about, and I don't even know if it's written on our notes here, but how to pay yourself in the most tax efficient way. That really, I don't understand that. Tell us about that. Okay,
so you're aware obviously that you don't pay any tax on earnings that you have up until you make 12.5 grand a year roughly, right? You might pay a bit of national insurance, that's fine, but it'll be minimal. And you should be paying yourself enough money and I'll come to this in a second, where you are paying national insurance, so you make sure you get a state pension, right? So this is different when you come to sole traders or self-employed people versus limited companies, right? Sole traders, partnerships, people who are self-employed and they're not limited, they pay the standard 0, 20, 40, 45% tax rates. And that's why when you get to 70 or 80 grand of revenue, or you start to hit the VAT threshold, that you really should become unlimited, because you're probably paying 40% tax on some of your profits that you might necessarily need those profits to support your lifestyle, but you're still getting hit for 40% tax. So you move to a limited company, right? And the beauty of a limited company is your company can earn money, but the tax rates are 19, 20, up to 25% corporation taxes now, as of now. But you can draw out as much money as you want personally as you need, and only pay dividend taxes, which are significantly lower. So the best way for somebody who runs a limited company to pay themselves is with a minimal salary of about £1,044 a month, pick you up to 12.5 grand a year through payroll. So you pay 0% income tax, but you pay some national insurance to get your state pension. And then after that, you should be taking dividends from your profits. So the basic rate dividend, and I know this probably is sounding like gobbledygook because I'm flying through it here, but the basic rate dividend's 8.75% tax. So if you wanted 50 grand out of a business, Jeremy, you take 12.5 grand as a salary, no taxes. And then you take 37,000 as a dividend, and you pay 8.75% tax, which is what, £3,400, somewhere like that. So you get 50 grand out of your company, but you only pay 3 grand of tax.
And do you do that at a certain time then?
Your accountant does that for you. Your accountant will do that. So, and I'm not going to ask you any personal questions here, like online, but essentially, if you're taking a salary only from your business at 3 grand or 4 grand a month, you're doing it wrong, unless you have a need for PAYE payroll income so that you can get a mortgage per se. So salary and dividends is the rule of thumb, first place to start. If you have a company and you're a director, that's how you take your money out, 100%, because your company can pay your pension contributions for you without putting it into your bank account, which is also tax efficient for a company, saves you corporation tax. So anybody, like for example, I'll give you an example. I chatted to somebody and they decided they moved to Dubai because they wouldn't pay any income taxes, right? From their limited company in the UK. And so they moved to Dubai and they started taking 70 grand, whatever they pro rata of 70 grand, probably 5.5 grand or 6 grand a month out of their business in the UK. They had bank account over there, right? But they're still a tax resident in the UK this year because they've been in the UK for most of the year. So they're still subject to UK taxes. So they've just messed it up. Whereas, you know, if they had done it right, in the UK they're only paying 3 grand of tax anyway. So that's the easiest way to get the money out of the business, and then you can do whatever you want with it. And that can involving a spouse in your business too, and making them a director, so you can take out money through salary and dividends and where appropriate. Caveat that where appropriate, and their name too. So does that make sense? Salary and dividends?
Like clearer than it's ever been, but very disturbing to me.
It is disturbing. It is.
Like everybody listening. So if you're listening and you've a limited company, if you're doing this already, unreal. If you're not, just say it again, that you should be taking for salary and then the rest dividends. Say that again, Orann.
12.5, 12,000. Well, I suppose it depends what your accountant says. Get your accountant to sort this out. It can be between £970 odd a month and 1,044, I think, a month. So you don't pay any income tax, but you still pay national insurance so that you can get your state pension, right? And then the remainder between 12.5 grand a year and £50,270 a year, which is a higher rate tax bracket, you take that as a dividend, and the dividend rate at the basic rate of dividend tax is 8.75%.
Okay, this sounds good. This is good stuff.
But what I would say is that if you breach that level, the dividend tax rate is 33.75%. So you have to be very careful, right? And I know for a fact people are going to listen to this and say, yes, but the company pays 19% taxes on its profits, and then you take money out and you pay 8.75%. So that you're paying 26% tax. Fair enough. But the benefit is, if your business has 100 grand a year in profits, but you don't need 100 grand a year to live your life. You only need 50. Then you take out the 50 and the other 50 lies there in the business and you've only paid 19% on it. Whereas if you were self-employed, you would have paid 40% on it. So you're saving 21% on that money, right? And that money can also be put on, used, you put 10 grand into a pension, which will save your company even more money in corporation tax. And so whoever's listening, yes, it doesn't make sense to be doing it through a limited company until you have 80, 90, 100 grand a year. That's why people don't really go limited until they get to that point.
Okay.
You know?
Okay, that'll definitely clear that bit up for people, but so much to learn. Oh my God.
I know that's a lot, sorry. And look, there's other things as well, Caroline, but that's the basics. Whenever you get up to big money stuff, there's other things called venture capital trusts, and you have enterprise investment schemes and all that stuff that you can use to avoid taxes. But that is for, you're up to hundreds and hundreds of thousands, if not millions of pounds, so. I
would say the majority of the Dig Podcast listeners are relevant to the information that we've just spoken about, I would imagine, most anyway. So, and again, this is just, it's not advice, it's just guidance. If anybody wants any particular advice for their situation, then they do need to reach out to someone like Orann, financial advisor, or whatever. And so and I know we're coming up to like an hour, I can't believe this, but we want to
keep her going.
Keep her lit. Okay, let's keep her lit. I had written down here retirement planning, but I think that we've already touched on that with the pension side of things. Is there anything else that you want to talk about in that?
We have covered it, right? And we've talked about the whole purpose behind pensions and the context of pensions and how they work. But one of the major things that we deal with is, how do you get money out of a pension? What's the right way to take money out of a pension when I get older? And what happens when I die, or what happens, blah, 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 blah. So there's a very common misconception that when you get to retirement age, if you have a private pension, that you get a lump sum of X amount and an annual income for the rest of your life. Is that familiar? Have you heard that before?
Right. I think so, yeah.
That's very common for public sector pensions. Like if you were a nurse or a teacher or whatever, or an OT or doctor, you retire and you get a lump sum of whatever amount, and then you get an annual amount of money for the rest of your life. And if you die, your spouse gets half of it, whatever you were getting, right? That's very simple when it comes to public sector stuff. Private pensions are not the same. So a private pension, you can take a quarter of it with no taxes. So that's called tax-free cash, 25%. But you can decide if you want what you do with the rest of the money. You don't have to buy an annuity, which is the guaranteed income for life. That's what you call that, an annuity. You can use what's called flexible drawdown, which is where you decide how much money you want out of a pension every year for a period of years. And to give you an example, say, we'll use you an example if you don't mind, and I'm just going to make up some hypothetical stuff. So you're 41 now, and you're going to say you work till you're 60 years old, and you're putting money into a pension, and by the time you get the 60, you've got £200,000 in a pension, right? And you say, Orann, time to clear the mortgage. I know I've got 200 grand in a pension, and I want to take the tax-free amount out so I can pay off my mortgage, but I don't need any other money out of it at the moment, right? You can do that with a private pension, but you can't do that with a public sector pension, right? You could say, Orann, I'm 60, I need to clear the mortgage, that's 30 grand, and the two Waynes are going to university, so I need 10 grand each for them, or they're buying their first house, I need to give them 10 grand each. Happy days, that can be done. No taxes, no nothing, whatever. And then you decide, I don't want to work as much anymore, so I'm going to reduce my working hours by a third. So I need to fill the gap between what I was earning and what I will be earning, because I am working less now. And you use your pension to do that. And you use flexible drawdown. So you take X amount to fill that gap for a period of years. But then whenever your state pension kicks in when you're 67, you stop the income from the pension, and the state pension will fill that gap. And then your private pension remains invested in the markets and grows again, and hopefully will make back some of the money that you have taken out over the preceding 10 years. So that's something that a lot of people don't know. And when it comes to sustainability of income and retirement, like we've talked about already, that's massively important, because people will have a pension with Scottish Widows or Aviva or whoever you see on the TV, and they'll ring them up, and Aviva will say, right, Mrs. Jones, you can take 50 grand as a lump sum, and then you can have 8 grand a year for the rest of your life. That's because that's all they can offer you. They can't offer you flexible income or flexible ways of taking money out of your pension. And the mistake that people make is they think that whatever their pension provider says is the be all and end all. And that's not true. It's not true. So that's really important.
We're the best place to find out all about what is available and what is out there. And that. Okay, so that is something that you do, is provide information on like different pensions and benefits and all of that. Okay.
Well, obviously I represent one company, so we only have our own pensions, right? But the actual context of how you take money out of a pension is really important, because and coming back to saving taxes, Caroline, if you're earning 50 grand a year whenever you're 60, right? And you decide, I'm going to start taking money out of a pension, right? But your pension provider says you have to buy an annuity or buy a guaranteed income of 10 grand a year. Your income's now 60 grand a year. So you have to pay 40% tax on the 10 grand a year you're taking out of that pension. Whereas if you use a flexible pension, you can take out the money you need without taxes, and then you can leave the rest of the time when you're not working as much, you're not earning as much, so you can save yourself tax.
Thanks. Better do things like, it's just knowing, and you just go into that cycle of taking people's word for it or whatever. So I guess like, and I'd written here, and you've already covered it, like that whole mindset of, well, you could be dead, what happens to it when you do die? So someone's from it in your family, and now we're kids, I'm more open to that. Like, well, I don't care if I do care if I die, but I mean, at least if I die, that money's going to go to the people that I love, and at least there's a reason now. Whereas suppose when with no children, and me and Jared were like, sure, we'll just enjoy the money now, but now I want them to be provided for with my. So look, this is a big, these are big topics, huge.
They are. You could spend all day talking about them. You could.
And we should be finding out all of this. And I am determined in my 41st year to get this sorted out, this situation with my money. And not that I have much, but I mean, I want, whatever I do have, I want to make sure I'm doing the right, smart thing with it. So thank you for starting that conversation. Is there anything else? Is there anything else that you could leave us with, like that you talk about, don't buy crap? Do people buy crap?
Well, metaphorically, physically, I would be worried if they did. They would, literally, but at the end of the day, the way that my own mentality, right, is we earn X. All you need to do is cut a wee one of those legs off the X, just a wee slice of it, and funnel that or siphon that out to things that are going to protect you and benefit your future self. So it's me, Orann, saying, I'm going to take a wee bit of this money and pay future Orann down the line, 30 years down the line, and I'm going to put it in places that are going to benefit me in the most tax efficient way, and where the government is going to give me free money. And as long as I do that on its own, then I'll be okay. And then I can decide how much I want to scale that up in the future. And so if you look at the normal structure of your finances, you should have your relevant insurances in your life. They protect yourself and your family against any debt and things like that. You have your property if you own a main home. You have your savings, you have your investments, and you have your pension. So if you can cover those main things and you have something in place for those main things, you'll be okay. It's just up to you to then decide how far do I want to take it and how big do I want the numbers to be. Because at the end of the day, Caroline, they're just numbers. You can put as much money into a pension as you want, but it's just a number. You might love to see it all. So you have to do it in a way that suits you and your life and what you're trying to achieve, not just because it's an easy way to save tax. You can have £1 million in a pension, but what happens if you can't pay your bills next month? That's okay. What's the point? And that's come back to, if you can avoid buying a wee bit of crap, it could literally be not buying a pair of shoes or not going out on a night out once a month.
That's what I was going to say.
Your future self. That's it.
What's the biggest thing that you see that people spend their money on? Like, what's the most common thing, just out of interest, that people are spending money?
Well, the common ones that you would be aware of, you have clothing, socializing, entertainment, holidays, vehicles. Vehicles is one that I'm not particularly comfortable with.
Because
the amount of money that people spend on vehicles, that is just, I actually had a conversation with somebody a few weeks ago, and they did earn reasonably good money. I think they earned 50 or 60 grand a year, but their car payment was £800 a month. Which, fair enough. If you really like your cars, if you're really a car buff, and you don't spend money on drink, alcohol, cigarettes, holidays, nothing, and you go, I want to buy that Range Rover, I want to buy that X5, I want to buy that Bentley or whatever it is, bloody go for it, right? But see, whenever it just is, I just wanted it, but you're still spending the majority of your income really on things that are costing you money, then, you know, at the end of the day, everybody should be focused on improving their disposable income, Charlie. The higher your disposable income is and the lower your commitments are personally, then the more freedom you have to do what you want. If you earn £2,000 a month and 1,800 quid of it's gone out in bills every month, then you've only got £200 left to play with. But if you earn £2,000 a month and 1,000's gone out in bills, then you've got £1,000, and that £1,000 might take you for your meal, or take you for your dinner, or take you on a night out or whatever, or go out on a date with your partner, or do the things that we're talking about in terms of paying yourself for the future. And ultimately, you know, I think very long and hard about financial commitments that I make. Even a gym membership, I think, well, if I'm going to take this gym membership, right, and this is going to sound really bad.
I love this. I hit the gym. Go ahead.
If I take this gym membership, I really need to use it, because if I don't use it, then that £500 a year could have been used to pay rates. It could have been used to pay the Wi-Fi. It could have been used to pay electric or gas. And so I always try and think of, what if I commit to something, what's it actually costing me? Because in that circumstance with that jar, 800 quid a month, that could buy you a house. You could own a house and pay for it, and pay your rates and pay your life insurance out of that. You know, if you're good with your money. Obviously, the average mortgage is probably going to be more than £800 a month now, but I try and think of it in a relative sense and rationalise it, because you're spending 10 grand a year on a car that it's not improving your life. You might look better, you might feel better about yourself, which is fair enough. I understand that. But over a 10-year period, that's 100 grand you're going to spend on a car. If you continue to do that, it's a lot of money. And remember, it's not 100 grand, it's 100 grand plus tax and national insurance that you had to pay. They have the 100 grand they pay for the car. So it's really 150 if you're a higher earner.
Oh my God.
Isn't that shocking? That's so scary. So scary. So, and that's something that keeps people up at night, you know what I mean? Whenever they actually realise that, and they're like, what have I done? And whenever you get caught in these types of agreements, you're on them for 5 years. So just work out the opportunity cost, because that leads on to people asking you then, how do I make more money? How do I make my money work harder for me? Well, if you weren't spending £800 a month, you could be investing it in a pension or an ISA or on the property, or you could be doing X, Y, or Z. But you've given up on that, all those opportunities for a nice wagon, which, you know, each to their own. But that's not the way I do my thing. That's not the way I think about it.
Yeah.
And it's not a matter of what's right or what's wrong. It's about understanding the implications of both. Because even if you don't opt for the expensive commitment and you do want to buy a property, you do want to do this, you do want to do that, it takes a period of time for you to get to that place first. You know, having an extra £800 a wages every month isn't going to buy you a house. You have to get the money saved up to actually go and buy the house first, but it'll get you there a lot faster. And then, you know, the real fanatics would say, spend the £800, save the money, buy a house, buy another one. Those houses generate enough money that will pay for the £800 a month car down the road. And then you've got the nice car, but you've also got the money and you've also got the assets and your trumps, you know. But that's fanatical, you know. And the average person doesn't really need to be thinking that way. It's more of safety, security, comfort. Quintessential middle class is what we should be aiming for at the minimum, you know. And the way that I see it is, if there's going to be a person in your family tree that's going to break a cycle, if you're in a bad financial position, then let it be you. Hopefully you can break the cycle and the people who come after you will be in a better position than you were at before, you know.
No, oh my God, this is unreal. Thank you so much, Orann. Like, I mean, it's not even scratching the surface, but it's food for thought. Yeah. A lot of people that are listening to me going away, calling up their person that had some of their finances, so speaking to their spouses, speaking to their partners, and trying to figure this out, because it's important. Like, we're working so flipping hard that we don't want to waste opportunities of making the most of the money. So this is really, really important. Thank you for sharing it online. We are, I don't know if you know this, but we've teamed up with Mars Pharmacy for Series 8, and it's all about looking after yourself, or like thriving in business and life. So what do you and I'm asking all my guests, and actually, I don't even think I wrote this to you in the notes, but what do you do to look after yourself? You mentioned the gym there, but like you're very busy, you're flying all over the UK and Ireland, probably all over the world that I don't know about, but what do you do to look after yourself as a busy person in the world of work?
To be fair, this year and last year was whenever I really started to think seriously about, the whole health, wealth and happiness thing, because you can have the wealth and you can have this. And I'm not saying that I'm the richest person out there, but I'm trying my best to get to my own place, I've always played sports. Like I'm not a big GAA man, but I play football, and I've religiously played football 2 or 3 times a week for the last 5 years. Obviously COVID didn't allow that, but recently I've started to do a lot more swimming and running. I'm planning, I done a half marathon last September, and I'm sort of trying to plan sporting or events that are to do with health ahead of time, so I have no choice but to do them. So usually, at the end of the day, I've always looked after myself in terms of the food that I eat. I try my best to eat good food and not eat crap, not bad crap. I like the odd takeaway every once in a while, fair enough, a few pints of Guinness, but generally I try to eat good food, and obviously taking in terms of physical shape, then swimming and running, I feel is the best. Going to the gym is more of a, something that I don't enjoy doing, but I know it's the right thing to do. I prefer the swimming and the running and the more social sports. And otherwise, you have to look after your head too, because see, when you're busy, it's very easy for things to go awry around you. And at the moment, my schedule is a bit, I would say, OTT in terms of trying to cram so many things in, but that's the thing that we have to deal with and adapt to as we go along. And unfortunately for me, unfortunately for my body, just things have progressively gotten more intense over the last few years for me professionally. So I am trying to step up to that level and be the person that I'm trying to be professionally, but I also can't let that affect who I'm trying to be as a partner or a husband, as well as looking after my own body. So
not easy, isn't it?
not easy. And again, I could waffle on about that. I'm doing a lot of waffling today, but
no, you're not.
Sports,
I see that.
Back to the sports.
I see that meme on social media. Like, I'm trying to be a good boss. I'm trying to be a good wife. I'm trying to be a good mom. And I also need to go to the gym tomorrow morning. And it's like they're frazzled, and you're like, oh, so I suppose we just have to keep working on it, don't we?
To be fair, one thing that I am trying to do, and I've always been this way, is if it's not today, it can be tomorrow. If it didn't happen today, and that's hard to live by. Sometimes it's difficult too. Like I'm doing a more professional qualifications at the minute, and I have an exam on the 13th, whatever day that is, and it's 150, 60 hours of studying required for it. And so I'm fitting that on too around it. And if I'm studying at 12 o'clock at night, that's fair enough. That's, and that's what I want to do. What some people might say that's insane that you're doing that, but at this moment, that's what I'm doing. But stick to the sports, look after yourself, talk to people, be open. And I'm trying to be more open, on things like this out there, because you can pretend that it's all easy and that it's all fairy lights and whatever, but it's not. So you have to look after yourself big time.
And that's why I love doing the Dig podcast, because actually when we open up a conversation about money like this, and when I say things and share my own experiences, and people in the background are like, oh, at least I'm not the only one. And it actually helps them out, really. So actually there's so much happens from a business podcast, and I'm really happy that people are sharing their tips at the end. Thank you for being on the podcast. Maybe you'll come back in another series and we'll go even deeper on a topic.
Yeah.
Rubbing
of course.
For any.
We'll see how it goes, and of course I would love to come back. Obviously, thanks very much again for giving me the invitation. I'm honoured. It's really nice to be invited on, so I appreciate it. And hopefully this is useful. I feel like I'm banging my head off the wall sometimes saying this stuff, because people are probably fed up hearing it from me.
For some people, this will be the first time they've heard this. I have no doubt, and that's the kind of impact you're going to have made with this conversation with me. So thank you, Orann. We'll see you in the next series of the Dig podcast. And to everybody who's listening, if you like the Dig podcast, being able to reach out to people like Orann and them say yes this is why it makes it so good. But actually the growth of the podcast depends on you. So if you're watching on YouTube, just hit that subscribe button, because thousands of people listen every week and they don't hit subscribe, but it'll help me reach out to people like Orann. And then if you're listening on Apple and Spotify, if you hit follow, it helps podcasts grow, and again helps people like Orann come back in future series. Thank you for listening to another week of the Dig Podcast.